Hello, today is May the 10th, 2023, and it's time for some new stock picks. As always, I'll review the performance of the stock picks from this time last year, give you a little bit of an analysis of current market conditions and where I see investment opportunities ahead, and proceed with 3 new stock picks for the 12 months ahead and beyond. So this time last year, I picked the Northwest Company Fund, symbol NWC, on Toronto, the Toronto Stock Exchange. It was up 12.5%, including dividends. Jabil, JBL, a technology company, it was up 38.8%, including dividends. PotlatchDeltic, a timberland stock, which was down 4.3%, and a small Canadian oil and gas company, Baytex Energy, which was down 25.6%. Those stocks averaged 5.4% in US dollars, including dividends. And in the meantime, the MSCI World Index, as represented by the URTH ETF, was up 8.6%. Since a year ago, inflation has been a problem. Central banks have raised rates quite a lot, from around 0% to around 5%. And stocks haven't really gone anywhere. They're mostly flat. Real estate is slightly down, depending on the sector. And under these conditions, asset prices, long-term asset prices, need to come down in price a little, because as the discount rate for the interest rates that we use to discount future cash flows and net present value for today has gone up, the fair value of these assets has gone down. So it hasn't happened yet, so it may happen, or earnings may, especially for stocks, may continue to go up and grow into the higher valuation now. For example, in the US market, the S&P 500 is trading at around 18 times forward earnings, at an earnings yield of about 5.5%. Earnings yield is the profit divided by the price that you pay for these profits, and this compares with a T-bill yield, which is the risk-free rate of return of just over 5%. So stocks under this scenario are not particularly attractive. But having said that, as we expect economic activity to decline over the next few months to a year, both inflation should come down and interest rates should come down. And typically when that happens, high dividend paying stocks are seen as attractive, and their price goes up. But even if that doesn't happen, in the meantime, you end up holding usually decent companies that pay you a decent dividend to wait while maybe nothing happens. So strong companies with strong balance sheets, with decent dividend yield that beats the yield of the 10-year Treasury at around 4.35 or so, 4.45 I think, would be my picks for today and for the next 12 months. First one is a Japanese company called Sumitomo Corp. It's an industrial conglomerate, various business units, metal products, transportation, construction systems, environment, infrastructure, media, etc. What's attractive about this company is its strong balance sheet. Its profitability is not the highest, but its valuation is really good. So that's stock pick number 1. Second one will be one that I've used a few times before, Manulife Financial, the largest insurance company in Canada. In this sort of environment, I think we want to be underweight or not particularly concentrated on the leverage side of the financial services sector, like the banks. So we would prefer the insurance companies. Manulife is one of the better ones with a very strong balance sheet and a decent dividend yield, around 4%, 3.9 or so. And it fits the bill of a strong company with a strong balance sheet with a decent dividend yield that we can hold on to make some money while things unravel. And the next stock pick for today is another Japanese company, Impex. It's the largest energy exploration and production company in Japan. And why hold a Japanese energy company when we can hold the Canadian ones? Well, we like most of the Canadian ones. Actually, the Canadian ones are really good, but this one is also good in that the valuation is really attractive. It trades at about 0.5 book value. So at a 50% discount to what their assets are booked on the balance sheet in terms of historical cost. And in theory, liquidation value could be close to book value. So the company could be liquidated and be worth more as assets to other companies than as a going concern. However, the company is decently profitable and it pays a decent dividend, so we expect the valuation to improve and therefore the price to go up and for us to make a decent profit. And while we're waiting, we're getting a 4.2% dividend yield, so not a bad place to have a little bit of money. As always, if you have any questions about whether these stocks fit in your portfolio or any other investment questions, please don't hesitate to give us a call. Thank you and have a great day. Bye-bye.